Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thanks very much for joining us. Coming up on the show today, Darren Sissons, partner and portfolio manager at Campbell, Lee and Ross Investment Management, will be joining us for the hour. Then in 30 minutes, StatsCan will be out with retail data for January. We'll break it down with Simon Gaudreau, Chief Economist and VP of Research at CFIB. And of course, we want to hear from you this morning on First Call. Reach out with your questions on global and technology stocks, and Darren will answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, if you want to go that way, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Iran is pressing ahead with attacks on Gulf states even after Israel signaled it would stop targeting the Islamic Republic's energy infrastructure. The war has killed more than 4,200 people across the region and brought shipping through the Strait of Hormuz to a near standstill. Iran's attacks on critical energy sites have eased from a peak earlier this week, yet crude prices maintaining their rise after closing yesterday at the highest since mid-2022. Unilever says it's in talks to sell its food business to McCormick in a deal valued at up to 29 billion euros. The potential sale would mark a major strategic shift, moving Unilever away from food and deeper into beauty and personal care. There's no guarantee of a deal, but it would be one of the biggest shakeups in the country's history. NVIDIA is facing new scrutiny in Washington over its $20 billion deal with AI process builder Grok. U.S. Democratic Senators Elizabeth Warren and Richard Blumenthal are questioning whether the deal was structured to avoid antitrust reviews. The probe adds to growing concerns about NVIDIA's dominance in AI as regulators take a closer look at how big tech is expanding its power. And now, of course, our top line story. Oil is back in focus this morning as the conflict between Iran and Israel continues to disrupt the Gulf and the rest of the world, for that matter. Both sides, though, have signaled efforts to avoid further damage to energy infrastructure, but uncertainty continues to add fresh volatility to the crude market. You can see now WTI is off about 1.5%. For more, let's bring in our guest for the hour. Down 1.5%. Just a quick glance there. So used to saying it's up. And let's bring in Darren Sissons, partner and portfolio manager at Campbell, Lee and Ross Investment Management. Darren, thanks as always for joining us. Another interesting day, and now we're seeing oil dropping a little, although Iran has said they're going to continue pressing attacks. I think you just summed it up nicely there.
Yeah. So, every day there's something new. I think overnight the big headline was the Qatar announcement on force majeure for the contracts. So, although a small supplier, LNG, that particular component, but it does signal that there is the exposure of contracts being broken and then effectively being repriced in the spot market. And if you look at what's happening in the spot market towards what's contracted at WTI and so forth, there is quite a large delta. So the optics are there. And then I think also in the background you've got, I think China recently announced that they weren't going to be shipping diesel to the Australians and the Kiwis. So obviously that's problematic. But I think that broader component where you're starting to see supply constraints manifest across different markets and also reflect pricing, it's really going to alter behaviour. And so the longer this conflict continues, the more volatility we're going to have. And really the second order effects are obviously inflation, perhaps decreased capital expenditures, and obviously unemployment as well. So there's a lot of things that could happen. But the best summation is I don't quite know what to say.
On a Friday, going to the weekend with them. So the force majeure, with what kind of an impact will that have right now? And then will we see others start to implement that as well?
Well, I think that's the question. So I think the size of the decision, okay, it's more optics than that. But what does it do to everybody else? Anyone who's creative, can they get out of their contracts? And then what does that do? Does that reset pricing? And so I think it's an arbitrage opportunity for some companies. even for some countries. But it's also when you're on the receiving end, then what does that cause? And that's actually causing, obviously, countries to think about their needs in terms of energy sustainability, in terms of whether or not they have the right national footprint. Countries that have idled, perhaps refining capacity, looking at bringing that back online. So I think there's a lot of moving chairs, and we'll have to wait and see how that plays out. And then obviously there's, at some point, people are starting to think about what does the rebuild cycle look like? Once the conflict ends, who gets the contracts? Well, I'd say at this point, Americans getting the contracts might be perhaps less likely than perhaps the Europeans and, say, some of the Asian countries. So, in that context, China might look very well positioned, given that it sort of stayed out of the fight.
And with those, we saw yesterday with Qatar talking about their liquid natural gas. They were saying 3 to 5 years to get it back online.
Why 3 to 5 years?
That was that was the number that they bandied about.
Yeah, I saw the headline, and if given the amount of money involved, why would it take 3 to 5 years?
Because of the amount of money involved? Because they can make a lot of money with it?
Well, but it's a fungible product effectively. So there's a supply, there's a demand component. So if you take your supply offline, okay, there's going to be perhaps the prices reset. New fields, marginal fields at prior levels of pricing then become economic. Mm-hmm. Countries will start drilling. So and then you also need to look at in the last 5 years or so, really at the peak of the ESG noise. A lot of the drilling was really persona non grata largely, but I think that's completely taken away. So now you might see majors obviously back drilling. So if Qatar says that they're not going to produce for 5 years, then I think other players will step up and solve that challenge.
Can they though? Would that be like places like Canada? Do they have the capacity and the capability to do it?
Well, I think if you look at what Carney said overnight, if I saw the speech, what he's looking at doing is starting to open up ports and infrastructure. And I think if I read between the lines, that's actually looking at ways to circumvent, provinces that don't want to play ball in terms of getting access through their regions. So an Arctic port for export would actually solve a lot of issues. And I think that would be a very positive activity. So obviously Canada's thinking about that, the US is thinking about that, Europe has got big challenges. And then you've got parts of Asia that have no energy and they need to have alternatives. So you're going to have part solutions, nuclear may be part of it, you're going to have renewables part of it, but everybody will be going back to brass tacks and looking at, where do we go from here? Do we want to have another vulnerability? And for the Europeans, it's the third time, right? You had COVID, you had the Ukraine shock, and now you've got this. So obviously they've got bigger fish to fry as well.
And with Canada, do you see this intertwining us with the U.S. more, or could this lead us to more independence on where we move our energy?
Well, I think that's an interesting question when you consider it in the context of the blending. So the US generally produces light crude, and they obviously need Canadian or Venezuelan crude, heavy crude to blend to enrich to meet the standards that they require in their refining facilities. So the question becomes, when we go to negotiate the USMCA, who has all the cards? Well, I think up until fairly recently, the current administration assumed that they had all the cards. And so if we have alternatives, we have cards to play. Right. And so we'll wait and see. So tariffs are probably less significant in the current context than the price of oil.
Okay, we got to take a break on that note there. But when we come back, we'll dig into answering one question many investors are asking themselves: is AI a true catalyst, or is it priced to perfection? How things are shaping up on the markets. We'll start with U.S. futures, and one bright spot, FedEx, with an earnings beat surging ahead of the bell. But you can see the Dow, the NASDAQ, and the S&P 500 all in the red right now, off by anywhere from 0.25 point to 0.4%. In Asia now, the Nikkei loves its roller coaster, off again, down by 3.38%. The Hang Seng down by 0.88%. All of this, of course, on Middle East concerns. And the CSI 300 also off by 0.35%. Heading to Europe, heading into the weekend. Oh, some green there. Surprise, surprise, considering everything that's unfolding. And we can see the FTSE up by 0.2, CAC 40 by 0.3, and the DAX about the same by 0.29. Looking at the TSX from yesterday, materials again taking a huge hit. That index is off nearly 17% in the last month. And overall, the TSX was off by 1.4 yesterday. Some of the movers and shakers: Vermilion Energy up 14.36%. Methanex 6.7%. And there you see it, Endeavour Silver down by 8.22%. And B2 Gold off by 8.25%. Its gold takes a hit. Looking at the metals, it's bouncing back a little bit today, but well below 5,000 right now. It's up today 1.74%. Silver, it's also way down, but today it is up 1.45, and it's still up, of course, over the last year. And copper down to 5.46, down 0.16%. Western Canadian Select, differential little changed, and yesterday it closed up 1.32% at just over $80 a barrel. And today, WTI is off. It's down 1.34% at $94.85. Okay, everybody is talking about AI. It's the hype. It's what we want to know is next, what's coming next, and it's a driving factor for the markets. But there are questions emerging about whether the future gains investors expect are realistic or already priced in. To break it down, now let's bring back our guest for the hour, Darren Sissons. Darren, thanks. AI, it's starting. We're starting to see it incorporated. Is it proving its value?
I think it's a little early. I think that you've got to look through a few different lenses. So I think one obvious analogy would be we've invented the wheel. Okay, it's still made of stone. It doesn't go that good. It's not a Maserati. It's not a Maserati wheel.
But it rolls.
It rolls, yeah. So the functionality, is it going to enable you to perhaps produce a piece of content for your boss? Is it going to enable you to do a little bit of analysis? That's fine. And will it speed up your workload and help your process flows? Yeah, sure, that's great. But what would you pay for that? The things that people would fundamentally pay for is if you could, big data could be used through these tools to perhaps come up with solutions that would tell you what foods not to eat so you could live longer, what to avoid so you don't get cancer. I could see people paying a monthly subscription for that type of thing. Then also for risk management and various things like that. So there is definitely going to be some functionality. But right now, I see it as an enhancement tool. The question is, what value do you put on that enhancement and how much would you pay for that? And so if you look at what's happening with AI, a lot of it's fairly low level, like chat bots. Okay, so then you can take out your company can take out its perhaps its call center and that it was currently operating out of Manila, so it's relatively low cost anyway, and they can have a chat bot. But then ultimately there's a problem, so you still need a backup support. So you may be able to save some costs, but how big is that? And then the question becomes, if it is significant and meaningful, and companies are able to fire 15% of their workforce, what's the cost associated with doing that? In this part of the world, if you're going to fire 15% of your workforce, that's a big number. And also, what's the brain damage? And then you've also got to look at what does it do from a demand destruction point of view. So if companies all of a sudden let go 15% of their workforce, that's 15% of the consumers that now have no money and are not paying their mortgages, not paying TTC or subway tickets and things like that. No one's consuming. Who picks up that slack and who pays for that? Does the government pay for that? So I think there's a lot of promise. I think the product is real, but where we're actually at in terms of actually the economics being produced, I think the delta between what the promises and what the actual delivery is still quite meaningful.
I mean, AI has to be able to create knowledge, and it can't do that yet. It can tell you things, but that's all from previous people that it's gathered its information, right? So
yeah.
And so it's still not at that point. I mean, so yeah, if you take it out, it's kind of if you take those people out of the system, it kind of stops learning to a degree, doesn't it?
Yeah. So where I think it's very good is it's probably very good at aggregating terabytes of data. Mm-hmm. So you think about it like all of the drugs that are sitting in the various cabinets for the various drug companies, and for example, you've got a drug called Lucentis. Was originally developed for prostate cancer. It's now used for wet macular. If a lot of that data can then be crunched and we can find alternative uses, then that can be life-saving and that can be meaningful. So really the question is, all the data that's being produced, can it be used more effectively, and are breakthroughs being moved from being dormant and finding other applications that can be done? Those are the types of things that AI will bring to the table. Obviously, as the product gets better, we get generative AI where the product can start perhaps natural learning. That would be interesting as well.
Yeah, that is a game changer. So where are you looking right now within AI then? Where do you see the possibilities?
So what we're obviously largely playing on the storage side. We have it through Google, we have it through some Microsoft. So we're obviously in the category, but I'm troubled by the NVIDIA story. Like fundamentally, NVIDIA is effectively just a processing engine. So the question you've got to get to on AI is, why does it need to be done in real time? Why can't it be done perhaps looking at different points in time, perhaps over a batch or overnight? When you start stratifying that AI decision process and you look at it over time, the cost has to come down. You don't need to run data in terms of analysis in real time. So then you get a question of what's the processing speed required. So I think you also need to think about where do the economics in the hardware and the software ecosystem typically accrue. Obviously, hardware is the lower order. Mm-hmm. Semiconductors are part of that ecosystem. But when you think about, what are the biggest companies in the world in terms of the technical, the IT ecosystem space, it is software. And so at the moment, we have most of the economics are accruing to effectively processing capability. Well, where are we getting the applications? Where's that coming? And we haven't seen that yet. So I think that's an interesting consideration to think about as well.
And so you're not as worried about software then?
No, I'm not. In fact, I think that, yesterday, Accenture reported, if you look at the stock, it had been decimated by the hype of AI, mm-hmm. and they came out with record numbers. So they've got a dividend buyback program. They've got a dividend increase, and they've got a share buyback process in place. So I think what people expect AI to do and what it is actually going to do is somewhat of a difference. But there are some enterprise software companies that look actually very attractively priced because they have very large moats that an AI product can produce an alternative, but the actual commercialization of that idea is very different. Right? That's the promise, and that's the delta.
Okay, we're going to wrap it up there for now. We're going to take a break, but we'll be back with Darren Sissons of Campbell, Lee & Ross Investment Management, and to see why Linda is on his radar. Time to see what's on the radar for Darren Sissons of Campbell, Lee & Ross Investment Management. Lind is what's showing up. What are you liking about them? They're full of hot air.
They're full of hot air, yeah. So Lind is an industrial gas company. And one of the things they do is provide hydrogen for refining facilities. So I think in an environment where we're going to see a lot of countries looking at energy sustainability, there is going to be scope for new projects. Mm-hmm. And the way the company works is they effectively contract to deliver a product, they spend $2 billion worth of CapEx, and then they get a margin on top of that. And in many cases, the contracts are anywhere from 5 to 10 years on a take or pay type contract up to 40 years for contracts. So I do think that's going to be quite interesting. And I also think, in terms of the US, the reindustrialization, you've got exposures to all the various gases are gone for welding. You've got oxygens for hospitals. So it's a very nice, stable business. It had a big inflection, obviously, just recently with regards to the energy. But I think if you look at the longer-term chart of the company, you've got a buyback program that is effectively in place every year. It's a dividend aristocrat. I think it's raised its dividend for 30 consecutive years. So it's the kind of name that you want to buy on a dip. So if you could have bought it in December last year, it would have been great. But if you look at a longer period of time, it's actually performed very, very well. We've owned it for a period of time, and we're sitting on a multiple of cost base.
All right. Next up, AstraZeneca. What are you liking about them?
So I would put Astra, in fact, I would put everything that is non-defense sector related and non-energy in the bucket of looking for opportunities and buy things that are on sale. So it has had quite a nice little run recently, but it has pulled back a little bit. And what it is it's a company that has a very robust drug development pipeline. They've had 5 blockbuster drugs approved since January 1st, 2025. They've got a number of advanced stage drugs that will probably be approved moving forward. So if I remember correctly, revenues will need to double in the next 5 to 7 years. So the pipeline's looking very strong. And when you can get a name like that on a dip, it's a good thing to do.
Not worried about the cut. There's so much competition kind of brewing in that field right now.
So one of the drugs,
especially the weight loss drugs are what.
Yeah. So let's talk sort of drug, because it's drug by drug, right?
Yeah.
So one of the drugs that they just got approval for deals with mantle cell cancer. So up until that drug was announced, there was no alternative for that. In effect, it was largely untreatable cancer. So that brings hope to people that have that illness. And if, for example, that illness can be cured or perhaps life extended, then that's a significant win, and people will pay for that. No one else has that product. So when you get a blockbuster, you are the only one that has that drug. You are dealing with a unique solution, and then after that, unique generic drugs will come along, and then the patent falls off, and the process continues. So drug companies are generally looking for new forms or new opportunities to new markets to spend.
All right, we got time to sneak in CN Rail.
Yeah, so CN Rail. So all of the rails, Canadian rails, CP, CN, both sold off quite aggressively on the back of the tariffs. So what we saw was, I think it was 97% of the goods that transitioned the border were covered under the USMCA in the current form. Now, moving forward, given we have the energy issue, the question becomes how significant are the Canadian heavy reserves in the context of a moving forward discussion? And so obviously the discussions are going to be belligerent, but I think we have cards to play. And the cards to play should mean a better deal. And we've also got a very integrated North American logistics market. So if you're on one side of the US, you can, your choices are a truck or a Canadian rail, a US truck, a rail or a truck on the other side of the US. So opportunities all around.
Okay, we got to wrap it up there. We got some economic news coming up. We'll be breaking numbers from Stats Canada on January's retail data with our next guest, and our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266 or send us an email, firstcall@bellmedia.ca. All right, Stats Canada has just released the latest Canadian retail numbers. It's for the month of January, and retail sales increased 1.1% to $70.7 billion in January. Sales were up in 6 of 9 subsectors, led by increases at motor vehicle and parts dealers. Core retail sales, which exclude gasoline stations and fuel vendors, and motor vehicle and parts dealers were up 0.9% for January. In volume terms, retail sales were up 1% in January. So let's get some reaction and a little more in-depth analysis. We bring in Simon Gaudreaus, Chief Economist and VP of Research at CFIB. Simon, thanks very much for joining us.
Pleasure to be here.
The numbers I know are just coming in, but the 1.1%, I'm trying to think. I'm trying to see what the whatever the analysts were expecting. Was it in line with it?
It's in line with what analysts were expecting, perhaps a bit lower. I think flash estimates were around 1.5% for January. And this rebound was made possible basically with the consumers catching up with some of the holiday discounting that happened around December. This is a welcome rebound, although perhaps a bit slightly lower than expectations.
Is that worrisome that it was lower? Like, but it's off by zero point 0.4 points with what analysts were expecting. Is that worrisome or no?
It is. I wouldn't say it's worrisome. It's showing a consistent weakness in the economy. This is something that's reflected also in other indicators. For example, for us at CFIB, our monthly business barometer is tracking weak demand with retailers. It's been ongoing for a relatively long period of time. We've tracked lower demand during all of 2025 and for the first 3 months of 2026 as well. We just released yesterday our March numbers, and this week demand seems to be quite sticky. So the numbers that StatCan released this morning are unsurprising, although there is growth. So that's the silver lining. But it definitely does reflect an economy that is not as strong as it could be.
Simon, what are your thoughts on when inflation shows up from the oil spike, and how sticky do you think that's going to be in terms of how it persists? Any thoughts on that?
Well, with the inflation situation, of course, there's a very high level of uncertainty. We're not sure exactly when this situation is going to be resolved. So as long as this remains, it will be very hard to sort of try to chart a course for a path for inflation in the next few months. Definitely, it has started to hit consumers and the economy. We're all seeing prices at the pump going up, and they keep going up as long as the situation is unresolved. For businesses, it also translates into higher input costs and raw material costs as the effects of this oil price shock makes its way through the supply chain.
Go ahead, if you get a follow-up.
Yeah, so just a follow-up question. So you're looking historically, when you've seen a quick run-up in energy, and I think the last time we saw was 2021, how long does it take to sort of work through the system when the prices come back down? What's the lag? We're looking about 3 to 6 months, or does it take perhaps a little stickier and takes a little longer to work through?
Well, I think, again, it all depends how the situation unfolds and how fast it is being resolved. I think for business owners, as they look at the current situation, they see the prices increase, and they will take measures also to mitigate those price hikes. So in terms of duration for how long this is going to take to process all of this, again, relatively hard at the moment to estimate.
Thank you.
And just looking provincially, all the provinces saw increases in sales. Where do you go with that?
Well, I think this reflects the fact that the situation that we're seeing, the shocks that we're seeing, we have to remember that what we're looking at are January data points. So back at that time, the trade war, the Iran situation had not started, and the impacts that were taking place, the macroeconomic impacts were kind of broad, and so impacting all economies in the same fashion to a certain extent. So that's why we're seeing probably all provinces showing similar patterns. Now, the story would be different if we were to take the temperature now. Of course, some provinces are more or less impacted by the oil prices because of their situation regarding production. We have provinces that will ultimately benefit from that as interesting as it may sound, but it's definitely going to hit consumers at the same time. For retail sales, that's the important factor to consider, and we can expect probably if this situation again continues to see some lower economic indicators going forward, including perhaps retail sales.
Simon, one other question. What raw materials besides energy are you sort of thinking through that have big impacts on the inflation side?
Yeah, so when it comes to raw materials, the way it could impact the supply chain is through anything that has an important energy component, whether it's oil or natural gas, because that's also a very important commodity here that's being impacted by the current situation. So you can think of things like aluminum, for example, that could be impacted. Prices for aluminum could be impacted by the current situation. And of course, we do have a lot of businesses that rely on that type of material for their products and their operations. You could have all other sorts of commodities that will have a major energy component attached to their production, and that again will make its way through the supply chain gradually and will impact the costs that suppliers and manufacturers charge or pay.
Okay, Simon, we have to wrap it up there, but thank you very much for joining us.
Thank you.
Simon Gaudreau is Chief Economist and VP of Research at CFIB. Up next, our conversation with the CEO of TC Energy, and our phone lines are open. Darren Sistens is taking your questions on global and technology stocks. Call us at 1-855-326-6266. Email us, first call at bellmedia.ca. Restrictions in the Strait of Hormuz have forced nations to look elsewhere for energy. Canada is one place that they've been turning to, but many say our lack of infrastructure and slow approvals process for building new infrastructure adds up to missed opportunities. For more on that, we spoke to Francois Poirier, Chief Executive Officer at TC Energy.
Customers aren't going to wait when they need to contract for LNG. They're not going to wait for any particular country who could supply their LNG to finish their regulatory process. They're going to sign up for that capacity when they need it. And of course, with the geopolitical situation that's going on, there's certainly a sense of urgency around securing LNG from different parts of the world to diversify their sources of supply and, of course, look for paths that avoid the Strait of Hormuz. So being a bit more outcome focused, being a bit more focused on the time-bound nature of the opportunity, I think is really important.
How long does it take for some other countries to get major projects approved?
We can just speak to our own example. On our Southeast Gateway pipeline in Mexico, from our original application to receipt of our full permits was 7 months. It was a project of national priority. We certainly didn't cut any corners in terms of environmental assessments, in terms of consultations with landowners and indigenous groups. And another example would be in Germany, when the conflict in Ukraine broke out. They went from concept to actually a regasification facility to receive LNG being put entirely into service in about 1 year and 2 months. So there are examples of countries being able to do this.
Okay, you've remarked about the demand and how much it's increased since the start of the conflict in Iran. How much more gas could you export if the infrastructure was available today?
Well, right now we're only moving about 2.5 billion cubic feet per day through the LNG Canada facility. Of course, LNG Canada is contemplating a doubling of that capacity to 5 BCF a day. There are 2 other projects that are looking to get built for LNG export, which would add about another 2.5 billion cubic feet a day. But I think we should aim high. Let's be the largest exporter of LNG to Asia, and that would be in that sort of 12 BCF a day range. The resource is there in the Western Canadian Basin. We have the know-how. We have a delivery advantage from the west coast of Canada to ship to Asia. It's a much shorter distance. It's about 8 days shorter than shipping from the Gulf Coast of the United States. And let's go after the business.
Is it worth investing now? Are we already too late? Does Asia have elsewhere to turn?
Well, this opportunity has come back around to us a second time, which is why I'm really making an effort to speak to this opportunity again. 15 years ago, we were at the start line of the LNG export business in North America with the U.S. Neither one of us had any export capabilities. If we were playing a hockey game right now, the score would be 8-1. We have 1 facility that's been commissioned and in service. The U.S. has 8, and they are the largest exporter of LNG in the world. I thought the opportunity had come and gone, but because of geopolitical tension, because natural gas has emerged as the fuel of choice around the world to balance affordability, reliability, and sustainability, the opportunity has come back around for Canada to punch above its weight, which will help us, of course, grow our economy. It'll help us diversify our economy away from the United States and create wealth for Canadians.
I wanted to get you on data center build-out, the hyperscalers building everywhere. Does CC Energy have any direct contracts related to that build-out, either in Canada or the U.S.?
We tend to focus on serving the utilities who in turn take the gas that we deliver them and generate power, and they're the ones who've been selling power to the data centers. Nevertheless, we've seen quite a bit of growth opportunity in terms of building out our pipelines to serve the utilities, who in turn are serving the data centers. And we see ourselves investing perhaps up to another $10 billion to serve that market over the next few years.
Okay, let me also ask you about Bruce Power. I know there was consideration of expanding the facility there. Is that still on the table?
Very much so. Right now we're in the middle of the refurbishment of the 6 existing units, and we've been very successful in bringing those in on time and on budget. Ontario definitely needs more nuclear capacity, and we're very interested in speaking with the Ontario government about expanding Bruce Power to deliver an additional 4,800 megawatts.
Okay, let's talk about the focus for 2026. We've talked about a number of different points, what we need to build, where we can get the product. What would you say is the company's overall focus for 2026?
Well, our focus on 2026 always begins and ends with operating safely. But beyond that, we feel there's an opportunity for us to sanction even more growth projects in Canada. We're seeing an awful lot of growth and investment opportunity in the United States, and it's attracted most of our capital over the last few years. I'd like to see us investing more in the Canadian marketplace, expanding our system in Alberta to allow gas to get to more export points and see better pricing in the Alberta market for our producer customers.
Well, I was speaking with Francois Poirier, Chief Executive Officer at TC Energy. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a cut for BMO.
Lured by lies of fast cash.
What did you think was in the bag?
Trapping young Canadians.
She's a 19-year-old girl.
As unsuspecting drug mules.
People pay a lot of money for cocaine.
W5 goes deep inside Hong Kong.
There are 4 Canadians in prison right now.
To uncover a crime syndicate.
She wants us to expose these people.
Hunting for traffickers.
They just asked me to find people for them.
Here at home, W5's Avery Haynes investigates. Saturday at 7 on CTV and Crave.
Let's take a quick look at some of the notable analyst calls and recommendations. Barclays has downgraded their rating on the Bank of Montreal from equal weight to underweight, but maintains its price target of $199. Barclays believes that BMO's valuation is stretched, even though they expect the bank to reiterate its target of a 15% plus return on equity and a 12% run rate for its U.S. banking segment by the end of 2027. When we come back, Darren Sissons will take your questions on First Call. Time for First Call and first email, and that one comes from Mike, who says, would like to get your guest view on Sun Life Financial. Thanks.
Yeah, so it's not a company we currently own. It's going through a process where the wealth management business in the US is obviously struggling, and the company is actually repriced to reflect that risk. But we do have a little bit of in the system, more legacy positions. But I think longer term, it's a very well-run company, and I think it is an interesting risk reward at these levels. I'd like to see the wealth management piece dealt with effectively, but thereafter, I think it would be an interesting opportunity to look at.
All right, let's we'll get a couple more emails we want to get in here. This one's from Duncan. Could Darren comment on McKesson stock? Would he be adding at this level?
Okay, so McKesson is an interesting company. When you look at it, you've got to look at the gross margin line and treat that as your net revenue line, because a lot of the prices just net pass through. When you do it on that basis, the metrics actually look quite attractive. It's effectively a tax on the delivery of pharmaceutical products, largely to the American public. And so I think on that basis, that's actually quite a good company, very well run. I've always struggled with valuation myself, but I think if it ever went on sale, it'd be something that we'd take a closer look at.
And any words that it could be cut out, that tax?
Well, I don't think they can, because the way the American system works is, for example, if like here, like I got a prescription filled relatively recently, there was a $12.99 to fill the prescription. Yeah. No, so whether it's a $5 prescription or a $100 prescription, you're still paying the $12.99. That's happen to be at Rexall. So you've got that across the US. You've got large population. The economics are quite sizable, and then you've obviously got some procurement elements and things like that. So I don't think that business is going away anytime soon, and obviously subject to a little bit of regulatory. But I think it's a good segment to look at.
All right, let's move on to an email from Paul. During earnings season, Canada's banking industry was being feted for their strength and consistency. Since then, stocks have been falling been falling. What has changed there? We just saw the Bank of Montreal, Barclays downgrading.
Yeah, so I think there's a couple of things that are happening. So last year, the Canadian banks moved north very aggressively on largely very little positive news. There was no significant interest rate increases that were going to power earnings. I think the tariffs, in many ways, have been quite negative on the economy. Mm-hmm. So the underlying economy is not that great. You add on top of that you've got a oil price that's going to cause challenges for employment. There are going to be some credit metrics. There will be some bankruptcies, as there typically always is. So, I think the outlook for the banks here is probably a little bit challenged. We may have to see higher interest rates to offset some of the negative impact from oil price spike. But there is also going to be associated credit losses. So, we like the Canadian banks. We own two of them. But I don't know if I'd be adding here. I think at these levels you want to wait and see. At this point would be my general opinion.
It sounds like it's going to be an interesting year for a lot of people.
Yeah,
a lot of companies as they try to figure this out.
So so far this year, if you've been in the energy and defence sector, you've done great.
Yeah.
Precious metals, for now. Precious metals were very good at this up until about the end of January, and then we've seen a recalibration across the markets. So if we do get continued conflict in the Middle East, continued inflation spikes, then that's going to be problematic for many companies. Anything from rents all the way through to just the cost of basic staples at the consumer at the supermarket are going to be challenged.
All right, let's get one more email in. This one's from Glenn. Is there value for United Health right now? Do the fundamentals justify a buy?
I think this is a tricky one. You've obviously had the CEO issue that was very untimely. You've seen the stock drop quite significantly. My general view on United Health is, given that we have a 3 to 5 year outlook, we tend to buy companies that have structural growth parameters. I think this is one you've just got to just wait and see what happens here. I don't think you really want to get in there. You could be catching a falling knife. You've also got questions around the US budget. They will have to expand the budget to fund the war. The biggest component of the US budget is the healthcare sector. They'll be looking for ways to cut costs. So really, do you want to really be going into something that's a little bit more questionable now than it was, say, 2 years ago? So for us, it would be a pass.
All right, we've got to wrap it up there, Dan, but thanks as always for joining us. Have yourself a great weekend, sir. And that is it for us on the street. Again, thanks to Darren for joining us. The Open is next with Lindsay Biscaya. Trading gets underway in a little more than 30 minutes. Have yourself a great day and a great weekend.